Some taxpayers are subject to alternative minimum tax. Are you? Check out my next show to find out what this alternative tax is all about.
Welcome to this episode of Accounting and Tax Tips. Smart strategies for small business success with certified public accountant Tina Moe.
The Alternative Minimum Tax, or AMT, was introduced in 1969 to ensure that anyone who benefits from certain tax advantages pays at least a minimum amount of tax. The AMT provides an alternative set of rules for calculating your income tax, and in general, these rules should determine the minimum amount of tax that someone with your income level should be required to pay. If your regular tax falls below this minimum, you have to make up the difference by paying alternative minimum tax. The idea behind the AMT tax was to prevent people with very high incomes from using special tax benefits to pay little or no tax. But the AMT kept evolving over a 42-year history and was starting to affect taxpayers who may not have had a very high income or didn't claim lots of special tax benefits. When this tax was introduced in 1969, it affected just 19,000 people. In 2011, it affected more than 4 million people and generated $102 billion in tax revenue. The problem with AMT is inflation. While regular income tax brackets are indexed annually for inflation, the AMT brackets and exemptions historically were not, so more and more people were being caught in the AMT trap each year. Combine that with Bush tax cuts from 2001 to 2006, which lowered regular tax rates for most incomes but not for AMT, and that pushed more middle to upper middle incomes into the AMT. Now fast forward to the American Taxpayer Relief Act of 2012, which went into effect on January 1st of 2013 and was retroactive for the 2012 tax year. This new patch successfully relieved millions of taxpayers from the AMT and calls for the brackets and exemptions to be indexed for inflation from now on. This is good news. So how do you know if this AMT affects you? This is the hard part, because a taxpayer can have AMT liability because of one big item or a combination of many small items on their return. So if you're a couple filing a joint return with an income of $80,800 or more, or a single taxpayer with an income of $51,900 or more, you definitely need to talk to your accountant about the AMT calculations that could affect you this tax year. Taxpayers with tax dependents and who take mortgage interest deductions, maybe have capital gains, and have high state and local taxes are at risk at becoming subject to AMT because those items are not deductible when it comes to calculating the AMT. You'll want to calculate to see if your regular income tax is higher than the AMT figure. If it is, then there's no AMT to pay. But if the regular tax calculation is lower, the difference between the two taxes is the amount of AMT that has to be paid on top of the regular taxes. AMT can add up to be between $2,000 and $15,000 additional on your tax bill. I know, ouch. So here's the moral of the story. Tax planning now can save you money and a bad surprise at tax time. For more information, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.